Mortgage insurers are reporting that a growing amount of loans are underwater, up to 6 times in some cases. So this is absolutely baffling statistics that we're going to dig through from the Globe and Mail. So mortgage insurers report growing number of homeowners with underwater loans. Okay, let's see what's going on here. Canadian mortgage insurers are guaranteeing billions of dollars worth of loans for which borrowers increasingly owe more than the value of their property. Financial disclosures from Canada's 3 major mortgage insurers show that the drop in home prices over the past year has chipped away at the equity in homeowners' properties. A rising number of them now owe more on their homes than they are worth, which ramps up insurers' risk of payout. And also think about how that constrains inventory, because those people can't even sell now because they owe more for the house than the house is actually worth. And, you know, when you take into account the real estate commissions and the cost of selling, they are totally underwater, a lot of people. So that could be another area where inventory is kind of constrained and being limited by this. And the thing is, this is an absolute disaster for the future. And it again shows that people putting less than 20% down and having one of these mortgage insurers there, they are the subprime people, because we're seeing that right now. They've got LTVs above 100%, which means they owe more on their property than it's worth. So it's going to be big problems ahead. The higher the ratio, the riskier the loan is for the lender and for mortgage insurers that cover banks against losses if homeowners default on their payments. Whilst mortgage insurers are showing historically low delinquencies, they are facing growing risks of elevated insurance payouts if homeowners are not able to make higher mortgage payments. And we already know from what's happening on the bank's loan books that these people cannot afford these higher mortgage payments at all. They're not paying down their balances. Their balances are only increasing. And you know, you only have to think about this logically, guys. If you lend somebody $10,000 and you say, okay, you can pay me this $10,000 over a year, and then that person comes back to you and says, I need to borrow another $5,000, and you're like, hold on, you haven't even given me back my $10,000 yet. And they're like, yeah, I need another $5,000. And it's like, well, how are you going to pay that back? And they're like, I don't really know. You know, that's kind of what's happening in the financial system right now. It's just because it's homes, it's kind of, I don't know, the home and the real estate assets have just kind of been the holy grail for so long in Canada. And I think that's what's led to this massive risk taking that we've seen by the banking sector. So kind of insane what is going on. So low delinquencies as well. I just want to show you this chart, which is Fred economic data. This chart comes from 2008, and you can basically see how before the global financial crisis, you know, delinquencies, where did they rise from? Historically low values. They came from the lowest values and they absolutely shot up, and they shot up for 5 years. So that's an insane amount of time, but it just goes to show that it can happen, guys. So, you know, I think this housing market is just built on a shaky foundation right now, and an earthquake is coming, and it's going to be a total disaster for a lot of these people because they're going to end up in foreclosure. It's pretty obvious that that's going to be the case. The disclosure provides a window into the precariousness of the mortgage market after the Bank of Canada raised its interest rate to 4.5% from 0.25% a year ago. The spike in borrowing costs slowed the housing market and led to a 15.5% drop in national home prices over the past year, whilst record immigration, remember that as well, guys, that in turn pushed some homeowners loans underwater. And then it basically shows you how the progression of the decline in home prices has gone. And then we get onto the data of what's going on at the mortgage insurances. So disclosures from Canada Guaranty Mortgage Insurance Co. show that its proportion of loans with an estimated LTV ratio above 100%, so that means they owe more on for their property than it's worth, increased by more than 6 times to nearly 4 billion in the fourth quarter of last year. That represented 5% of its outstanding insured mortgages for individuals, according to Canada Guaranty's quarterly portfolio metrics. That is up from 532 million, or 0.74% of its outstanding insured mortgages in the fourth quarter of 2021, according to the disclosures. So Canada Guarantee, we know who owns that, the Ontario Teachers Pension Plan. So you've got pension funds that are tied up and involved in this mortgage insurance fiasco, and it looks likely that it's going to turn into a complete train wreck, because we are seeing the borrower is basically just being hammered. They can't pay back their debts. And what are they doing? They're taking on more debt. The bank is just saying, here you go, have some more debt. We're just so generous to you. Just you can get into more debt to pay your mortgage. And it shows how people have kind of hit the roof in what they can really afford. And this kind of shows that we got into that phase, that kind of phase of the bubble in 2021, which was essentially this new paradigm. Oh, home prices are just going to go up forever, and everybody just jumps into the market taking insane risks. There's insane amounts of fraud in there too. It's just unbelievable, guys. And all this will come out. All this will come to fruition, and you'll see. And I think people are going to be, quite frankly, disgusted, and it's going to leave a sour taste in their mouth going into the future when it comes to real estate, when they find out how this has been built up to, it's an illusion, essentially, an illusion of wealth. So Canada Guarantee calculated estimated LTV ratios by using the current mortgage balance divided by the estimated current property value. And that's accurate as well. The company adjusted property values based on recent declines in home prices in different communities. And again, you've just got to see, are they actually doing a good due diligence on that? Sagen, another private mortgage insurer, had 14 billion, or 10% of its outstanding insured mortgages with an effective LTV ratio over 95% in the fourth quarter of last year. That's compared with 7 billion, or 5% in its outstanding insured mortgages in the same period in 2021. So it's doubled. So we can see how the financial distress is there right now. And it's the regulators, the Bank of Canada, the government, they are all asleep at the wheel, as we know, because they have been praising this negative amortization as some sort of good idea. So kind of hilarious. But anyways, CMHC, the taxpayer-funded mortgage insurer, showed similar growth in its LTV ratios for homeowners with insured mortgages. Its results for the third quarter of 2022 show that 2.8% of its insured loans had an updated LTV over 95%. That represents an outstanding insured mortgage balance of $5 billion. And just think about all these loans, guys. These are all people that cannot sell their property right now. And if a recession hits, which we know it's going to hit from looking at the yield curve, then you're going to see these people likely worse off, affected, and in foreclosure, essentially. And, it's really sad that it's got to that point, but, this is just the cycle of what happens in a bubble. It gets highly emotional. And, I think the CMHC, all these mortgage insurance, I don't even think they should be there. I do not believe the mortgage market should be distorted and taxpayer funded, because then that takes the risk off the banking sector. It creates huge moral hazard, as we're about to see in possibly $1 trillion blow up of the financial system, because the real estate market has gotten so large, and it's also created so many malinvestments on top of that, which have took money away from things which would have actually provided useful output for the economy, versus just complete crap and garbage. So kind of crazy, guys, but this is where we are. And then lastly, the Bank of Canada, what do they think? The Bank of Canada has said it's fully aware of the impact of the higher interest rates have had on borrowers with variable rate mortgages. In Canada, the most popular variable rate product has fixed monthly payments. And they said that broadly, but really it was just a pandemic thing. If you really think about it, it's just something that's really kind of boomed in the past 3 years. And we don't know to the extent of why that's happened yet. But I'm sure when we have this in the rearview mirror, we're going to find out that it could have been bonus related through the banks. All kinds of things could have been happening, which were pushing brokers to recommend these garbage products, essentially, which could end up blowing up the financial system. It looks likely because this is just a deteriorating situation. And I mean, gosh, if you're in the housing market right now, first-time home buyer, you're taking huge risks, just massive risks. And I hope you know what you're doing and you're putting a massive down payment down because you may need it if home prices continue to tumble further, which looks likely, even though we've got a little bit of a spring market rebound on our hands right now. That happened in 2008 too. And then the economy went into a recession. And it wasn't just Canada, it was the global economy. And you have to remember stuff like that. It's it's all part of the bubble. And I've got a video coming on that. In fact, the bubble cycle. So in Canada, the most popular variable rate product has fixed monthly payments. That means when interest rates rise, a higher share of borrowers' monthly payment goes towards interest and less towards principal reduction. And we know how bad that has got at different banks, CIBC, BMO, all these other banks, and their mortgage books, a lot of their mortgage books, like 30%, the balances are increasing. Those borrowers are in distress. And the regulators, the Bank of Canada, the government, just sitting on their hands, not doing anything about it, praising the banks, which shows you how much control the banks really have. So I want to show you this lastly, which is Canada household credit market debt to disposable income, which is at 180% right now. And you can see it's pretty much been around this 180% level. We crossed over it since 2016. So you've kind of seen it peak up here for a long, long time, and it just went above it, and now it's correcting down. That's not a good sign at all. But it looks obvious to me that we've kind of stretched the amount that the people can afford in the real economy to the absolute limit. They can't go any more than 180%, and it is just a total train wreck and disaster. You've seen real wage growth absolutely collapse, as I've shown you in previous videos with the chart that I had to create, because the central planners and the authoritarians and Statistics Canada and all these government entities, they don't produce these statistics because they don't want you to know how much the government, through their deficit spending, are basically inflating your wages away. And it's just kind of insane. So anyway, I hope that's kind of provided some insights into what's going on right now. Again, the housing market, the deterioration of the housing market actually just continues, even though there's a spring rally. It's a sucker's rally. It's a bull trap, in my opinion. And we'll continue to see how this plays out over time. But it does not look good. It looks like a repeat of the global financial crisis, but on steroids with much more debt. So anyway, if you've enjoyed this video, you might like that video there. You might also like that video there. With Bill C-11 and things like that being passed right now, please sign up to my free email letter and email list in the description. I'll see you in the next